Hi there. I want to take a moment to respond to Silver Selly, who left a comment on the page. The comment was, "All of this seems meaningless to me. How can analyzing graphs tell us anything about market fundamentals? I just don't get it." Wow, what a great question that is, because so many of us who've accepted technical analysis and worked with it for years have also lost sight of the fact that for many people it's mumbo jumbo and they don't have a frame of reference to even get started in understanding it. I don't pretend to be able to give them much of a head start, but I want to just lay out some real simple basics here, and then you can decide if it's mumbo jumbo or if it's something that's worth looking at. Let's look at the extremes here for starters. Fundamentals are based upon the information that flows to you and I through official channels, and there are people who are totally committed to fundamentals and only fundamentals. They scoff at the idea that pictures, charts, and graphs could have any value guiding adults in making their investments. But consider two facts for a moment. First, there's the reality that fundamentals are based upon reports assembled by people, and people make errors. These errors could be substantial, and they can be compounded by other errors. And, fundamentals may not always be so accurate for that reason. But that's not even to touch upon the other side of the question, which really is even more dramatic. Financials can be fudged. It doesn't take an investigative reporter to realize that numbers are often fooled around with by the big companies in order to look better, to look worse sometimes, but usually to look better. Think about Enron, think about the banking crisis, the S&L crisis of 2 decades ago. How do we get into those problems? Well, people fudge numbers. How deep this corruption goes is anybody's guess, but between incompetence and criminality, there's no telling what's real and what's not in fundamental analysis. Too much of it has just simply proven to be wrong. Okay, now just because fundamental analysis is not reliable, it does not mean that charts are. However, it doesn't mean charts aren't either. So let's take a look at why charts may have some value for people who are prepared to look at them as a guide to investing. Consider this. Every day the market trades, we don't know the exact cash balance, the sales, the inventory, or the tax position of any given company. But it is traded on the open market, so we do know the following. We know the prices it traded at today, we know the price it closed at, and we know the volume of trades that took place. Those are facts. And if we write those facts down, tomorrow, when it trades, those will be facts, and we can write those facts down. And day by day, we can construct a drawing which is based absolutely on facts, from which we can make some determinations about what's going on with the stock. For example, is the stock going up or going down? That alone is a kind of charting, because it's in reference to previous day's activity or previous week's activity. You can't know whether the stock is trending up or trending down unless you know the history of the stock, and basically that's a chart, no matter how you want to call it. Okay, but that's just the start of it. Today is the undeniable record, today's prices are the undeniable record of what people are thinking the company is worth. It's their commitment to today's knowledge. Now, they may be wrong or they may be right, but it is the fact of today's commitment. So here's the basic premise of technical analysis. By studying today's price action and the price action of the past, we get a drawing that represents the collective thinking over time of all the investors who own a security. After that, the interpretation of the chart is open for discussion, but we at least have to agree with each other that this is a graphic representation of collective thinking. So let's look at some of the basic ideas that chartists would like us to look at, because after all, investing is really psychology. If anybody doubts that, I'd be surprised, but if they do, look at what happens at market bottoms, tremendous depression, market tops, euphoria, bubbles. That's a totally psychological phenomenon. I think we'd also tend to agree that major dollar milestones represent places where people are likely to buy and sell. We all have a natural tendency to buy and sell at certain prices, $10, $25, $50, or $100. We tend to put our prices in and think about the price movement in terms of some kind of a number, which is usually a round number. Not always, but that tends to be human nature. When we see a stock repeatedly hit a low price, say $10, over a period of months, it'll rise, fall to 10, rise, fall to 10, rise, fall to 10. We might start to think, based upon the evidence of its actual price movement, that $10 was significant. How is it significant? It's significant because buyers are willing to rush in at $10 and buy stock to keep that stock from falling. If the buyers didn't come in to buy it, it would fall further. Do we know why they act this way? Probably not. What we do know is they actually do behave this way because they actually did buy the stock and somebody sold it to them, but there wasn't enough selling to drive the price down. So as technicians, we assign that $10 level a name that we call support. It's the support level. Does that mean that price is supported there forever? No. In fact, prices can fall below the $10 level and will probably do so at some point. But what we see is that the $10 level, which was considered support, once it's broken to the downside, can become overhead resistance to the price advancing. Well, why is that? Well, maybe not always sure, but it just may mean that there are more sellers who don't feel too good about the stock than there are buyers willing to buy it above $10. So what happens is the price rises up to $10. The discouraged owners of the stock feel, well, here's my chance to get out on a pretty much break-even basis. They put their stock on the market, they sell it, and that drives the stock back down. Without a flood of buyers strong enough to overcome the sellers, we stay under $10 with that stock, and we probably drop to some arbitrary level. The same phenomenon can apply when prices rise. At some point, let's assume we see the price rise, for example, from $10 to $20, and then it retraces to 15, and then it starts another advance and goes to 25. So we have 10, 25, 15, 25. 10, I'll say it again, from 10 to 20, from 20 to 15, from 15 to 25. Okay, so far so good. Higher highs, higher lows. That's an uptrend. Anybody realize that what we have here is two bottoms that can be connected by a straight line? Yes, it's on a slope, but that slope tends to represent an increasing level of support for that stock. The third time it pulls back to that line, well, you may think it's, there may be a case to be made for that line supporting that price. Now, when you study this stuff long enough, you'll see that certain times it does and certain times it doesn't. But the point I want to make is that line is a valid place to look for certain things happening in the price of the stock. So it's something to keep an eye on. Remember, technical analysis is not a fortune-telling tool. It's an analytical tool. It's a forecasting tool. And forecasting is not predicting. I can draw a line across successive bottoms in price, for example, and determine if the trend is upward or downward. And curiously, the third or fourth time that prices touch that line, we may determine that the line has some predictive value, even though it may not be 100%. If the line, however, predicted with 50% certainty that prices will touch this line and not break it, that alone has value in forecasting future price action. And there are those who claim that by by looking at the price action and the volume and the patterns of behavior and what's going on in the news, that you can start to get a feel for what the likelihood is that the stock will either be supported at that price or not be supported at that price. Now, technical analysis can get quite involved. Endless Mountain here on YouTube does a great job with Fibonacci analysis of the stock market and a silver market and gold market. Way too complicated for me. I'm not smart enough to figure that stuff out. I just like my nice simple trend lines. But people do perform a lot of higher mathematical functions, and it doesn't mean that they're not valid just because I don't understand them. There are plenty of others who just stick with the basics, and they feel that there's some value for them in that. Just remember that anyone just remember that anytime someone talks about a moving average, momentum, a trend line, or volume, they're stepping into the world of technical analysis. In case I'm making this too sane, as a closing point, I want to draw your attention to a gentleman named Arch Crawford. His website is crawfordperspectives.com. He has been probably the most successful market timer with a newsletter in the last 30 years. And Arch bases his analysis on not just charts, but on astrology. Okay? Nonetheless, he is pretty much the #1 newsletter guy in the country. So, I can't tell you he's right or wrong. I can't tell you why it works, but that's his record. So, maybe it is all mumbo jumbo. But I'm looking forward to hearing back from anybody who wants to comment on this, anybody who's got other suggestions about how to use charts, and good trading to everyone.